Well, it's finally happened. Michael Burry is back, and he just made his biggest investing moves in years, selling his entire portfolio except for one stock, and sending a message of what he thinks of the current stock market and why we may soon see a global drop in stocks over the next 3 years. So if you don't know who he is, Michael Burry was one of the few investors who predicted the housing bubble before the whole market collapsed in 2008. He ultimately ended up making over $700 million for his investors and profiting over $100 million personally off that one trade. So if you've been watching the markets at all in recent years, you've seen the continued rise in stocks, with the S&P 500 index recovering from the dip to approach a new all-time high in 2025, after already hitting new highs 50 separate times in 2024. So a lot of investors are wondering, how much higher can this really go? With many famous investors like Warren Buffett even selling huge amounts of their stock positions. And Michael Burry in particular is interesting since he's correctly called every last major stock market crash. He shorted the dot-com bubble in the early 2000s. He famously predicted and profited from the subprime mortgage crash that kickstarted the Great Recession. And he made a fortune shorting Cathie Wood's ARK Innovation ETF during the tech crash in 2021. Love him or hate him, this guy has made a lot of money off of his big bets. But after deleting his Twitter in 2023, Burry has gone silent on the markets, at least publicly. But luckily, we can still use his trades to see what he's thinking. So this is Michael Burry's fund, Scion Asset Management's 13F filing. It's a document that lists all the stocks the company owns and the trades that they're making. It's basically like a cheat sheet for what Burry is trading. Not to copy him, but to understand the forces behind his trades. And his latest moves, they are pretty dramatic, and they show exactly what Burry sees in today's market, and more importantly, offer a warning about where things could be headed next. Because when someone with Burry's track record goes all in on one play, that's enough to capture any investor's attention. So Burry's biggest move is his new bet against Chinese companies. See, back in late 2024, Burry was actually holding several Chinese tech stocks, Baidu, JD.com, Alibaba, probably because they looked cheaper than similar US tech stocks. This chart from Bloomberg back in 2024 shows it well. The Chinese tech market just hadn't run up as much as the US had. But now, several months after Burry first bought these stocks, the situation's changed for international investors. After the Chinese company DeepSeek released a ChatGPT competitor in February, Chinese tech soared, and that rally in Chinese tech boosted valuations. But if we look at this latest report, Burry didn't just cash out. He went one step further, placing put options against many of those same Chinese firms. Put options are a way to bet that a stock will drop, and pretty quickly. They don't just show doubt in a company, they show conviction that it will drop. So just like he did in 2008, Burry is not warning from the sidelines, he is placing a bet against this part of the market. But here's where things get interesting. This isn't just about China. It starts with those stocks, but it's part of something much bigger. So why did he make this bet? Well, some see this as a reaction to the renewed U.S. China trade tensions, which seemed to stall the rally in Chinese tech before it even really got going. So maybe the cheaper Chinese tech stocks just aren't worth the extra political risk anymore. But I think it goes deeper than that, because Burry's not just targeting China. He has also taken out a put position against Nvidia, one of the fastest growing US tech companies of the last decade. This is the same Nvidia whose stock is up over 1,000% in 5 years. So a bet against both US and Chinese tech, that sounds less like a regional call and more like a silent warning about global tech valuations. So what, is this the next dot-com bubble? Well, that word does get way overused, but Burry did actually predict that we were in a speculative bubble back in 2021, and we actually saw a big sell-off in tech afterward, with tech down 30% from its all-time highs. But today, in 2025, valuations have now risen higher than ever. So what I see happening here is a continuation of Burry's bet that I talked about in my last video. See, we are now 25 years after the original peak of the dot-com bubble, and we are seeing some parallels to that time, a time when tech stocks were wildly overhyped and investor money flooded into anything with .com in the name. Some investors have drawn parallels to the current rise in AI stocks. But today, we've actually surpassed that previous bubble in terms of US equities concentrated in US tech stocks, with tech valuations pulling ahead of the rest of the market. So in a way, Burry is right. Tech stocks are now more valuable than ever. But this isn't about panic for Burry or getting scared out of investing. It's about being informed about the data. And the data shows that Burry is clearly making a bet against global tech during a time of current US trade tensions. But while that is an interesting bet to look at, it's not what's going to matter the most to investors in this report. See, while tech valuations have climbed, tech company earnings have actually risen at basically the same rate. Stock prices are up because company earnings are also up. So Burry could absolutely be right that tech stocks will correct from here. But this is more of a short-term bet, the kind that he has been wrong about in the past, both on specific stocks or even whole sectors. But it's Burry's second, longer-term bet that really caught my attention in this report. So let's look at what investors can do about Burry's tech prediction and then turn our attention to his long-term bet against the global economy. So if you're a long-term investor like me and you don't have billions under management, it probably doesn't make sense to start shorting tech because the data shows that holding a diversified ETF tends to outperform trying to jump in and out of different stocks. These ETFs are baskets of stocks that include tech, but they also include other industries like energy or medicine. Here are some examples on screen. So even if one part of the basket declines like tech, the rest of the basket can still remain strong. It's almost like a basketball team, where if your star player has a few bad nights, the rest of the team can still keep you in the game. But while Burry's tech shorts are getting all the headlines today, the real warning in this report is buried in what he bought. A $13 million move that doesn't just look like a trade, it looks like a long-term bet against the US economy itself. And if he's right, the fallout could hit markets around the world, ETF or not. So let's look at this trade, what it signals, and how regular investors can protect ourselves if Burry is right. So Burry only made one purchase this quarter in a beauty stock called Estée Lauder. This is a company that sells beauty and skincare. It's a lipstick stock. But what caught my eye wasn't the company itself, it's what this type of stock signals. See, Estée Lauder belongs to a category of companies which are often called lipstick stocks. And this type of stock often acts as an indicator of future economic recessions. So by Burry buying this stock, it looks like a direct bet on a coming US recession. So look, this sounded really crazy when I was first researching this. I mean, a lipstick indicator that predicts recessions, but I followed Burry down the rabbit hole and I found some pretty interesting connections between beauty stocks and economic downturns, which is important to investors because it could provide us with a warning sign to watch for before the stock market drops. So let me take you into this weird, compelling, kind of obscure rabbit hole of Burry's mind and see what is the actual evidence of a coming recession. So all of these trades that I'm looking up for Burry are public information. He has to share them. But you can find a lot of information that people never wanted to share that's been leaked in data breaches. Like, how do all these junk mail companies have my name and address to send me targeted credit card offers and cruise line advertisements? Well, if you've been watching for a while, you know that this is caused by data brokers, shadowy companies that scrape all the pieces of your data that they can find and then sell it to the highest bidder, often without much care for what the bidder is going to do with your data. And the number of victims of data breaches keeps going up every year. The most recent data shows that the number of victims is up 41.5% since 2021. I mean, I don't even answer my phone anymore if it's an unknown number because it's always a scammer, which is where this video's sponsor Incogni comes in. Incogni is a service that will go out and contact data brokers to remove your information. I actually tried to do this myself once, like manually going out and requesting sites to remove my data, but I found hundreds of sites and I gave up after maybe 5. And that's not just annoying, that's a risk given what people can do with some personal information and a good AI voice these days. So I've been using Incogni for a few months now and it's great. They've removed my personal data from over 700 sites so far, saving me an estimated 585 hours if I were to try to do it myself. And with the yearly subscription, they'll continually monitor these lists to make sure your data stays private. So you can go to incogni.com/fintech to get 60% off their annual plan. Make sure to use the code FINTECH at checkout to keep your data off these sites. Okay, let's pick back up where we left off. Burry's strange bet that a beauty stock holds a deeper economic signal for the market. So this is a study from the Journal of Personality and Social Psychology from 2012, and it offers some of the first real evidence of a lipstick effect during an economic downturn. This study found that on average, women's desire for products that enhance their attractiveness actually increases during hard economic times, bucking the usual trend of consumer spending decreasing during a downturn. And in 2020, researchers looked at data from historical recessions and found that the lipstick indicator was real. During the Great Recession, spending on cosmetics actually increased among women aged 18 to 40. So there is some truth to the idea that beauty or lipstick stocks outperform during and in the lead up to an economic recession. And Burry's choice of stock, Estée Lauder, absolutely followed this trend. This chart shows how the Great Recession in 2008 kicked off one of the strongest bull runs Estée Lauder stock has ever seen, far outpacing the S&P 500 in the bottom chart over the same period. But even more recently, we've actually seen a decline in beauty stocks. L'Oreal and Coty have both dropped substantially this year, while Estée Lauder is down a crazy 81% from its all-time high. So it isn't like Burry is buying this stock because he loves the direction the stock is going. If anything, it's underperformed. So while Estée Lauder might seem like an odd pick, Burry's not buying the brand, he's betting on the pattern. This isn't about lipstick, it's about what changes in consumer behavior say about the economy. And just like he did in 2008, Burry is using that behavior as an early warning signal. So why now? Why place that bet today? Well, to answer that, we need to look at the other warning signs of a recession, because by spotting the signals early, we have time to prepare. And I'll also share some practical steps that regular investors can take whether Burry is right or wrong. So it's well documented that consumers spend less during an economic recession. That's pretty much common sense. People try to save money when times are harder. And it's not only a US thing. There's actually a research article from Portugal that shows the same effect because obviously. But spending doesn't just drop during a recession. When it drops, it can actually contribute to starting a recession. In fact, cutting back on spending is one indicator that economists use to determine if the country is currently in a recession, how much spending power the average person has, with the two other predictors being declining GDP and rising unemployment, which we'll also look at in a second. But these indicators are all connected because less spending means lower GDP, fewer jobs, less economy, which at its core is basically what a recession is. And a recent McKinsey study found that all groups of US consumers have started looking for ways to cut back or trade down on spending, especially among Gen Z and millennials, who are cutting back faster than any other group. And this pattern is similar to what we saw in 2008, when consumer spending dropped several months before we entered an official recession. It's one warning sign that investors can look at to help us decide if we need to start preparing. So today, people are cutting back on spending. Check. People are tending to spend more on cosmetics, and the beauty market has actually been growing faster than global GDP since 2020. Also check. But a quirky trend and a small slowdown alone aren't enough for someone like Burry to make a bet like this. So let's go deeper into 4 other economic indicators that could explain why he's betting on a recession, and more importantly, what they mean for your investments and protecting yourself in a market downturn. So if you're a stock and economics nerd like me, you're probably familiar with the most famous indicator of a recession, the U.S. Treasury's yield curve. This measures how much interest U.S. Treasuries will pay investors for a short-term treasury versus a long-term one. And it has been showing warning signs since late 2022. So historically, anytime the 3-month Treasury bill has paid a higher rate than the 10-year Treasury bill, called a yield curve inversion, we have seen a recession shortly afterward. This is because you'd expect to earn more for locking up your money for 10 years instead of 3 months. So when the long-term rates fall below the short-term ones, it's a sign that investors are worried about the future and expecting things to get worse. But today, it's been nearly 3 years since the yield curve inverted, the longest inversion in modern history. The only other time we saw a yield curve inversion without a crash was a false alarm in 1966, but that was also a much smaller inversion. So it was right after this flip first happened that Burry started sending his strongest warnings to the market. But we didn't yet see a recession, and maybe given the Fed's aggressive interest rate hikes in recent years, it is possible that this indicator alone won't be as predictable as it has been historically. So let's pair this with a super indicator that bundles a bunch of useful indicators into one single number that we can track, since that number is also flashing a warning sign for the economy. The leading economic indicators, or LEI, is an index that tracks a mix of several different indicators, including job data, stock prices, and product orders. And by looking at its 6-month growth rate, we can get an estimate for the future growth rate of the economy as a whole. And remember, that is one of the big determiners of a recession besides consumer spending. And historically, when that LEI index 6-month growth rate has fallen below -5% growth, it has been a strong predictor of a coming recession. Now, this actually did drop into that red zone in 2022, but similar to the yield curve, the Fed raising rates may have skewed the data temporarily, explaining why there hasn't been a recession yet. But as we can see in this zoomed in version of the chart, the index has been dropping since 2022. Only this time, we can't blame the Fed raising rates on skewing the numbers, which means economic future growth is slowing. And this is also backed up by the latest manufacturing data. Basically, everything in red here means manufacturing is declining year over year. And if we focus on just the US for a second, its numbers aren't terrible, but they are far below the average that we've been seeing since 2008. So these two indicators, the yield curve and the LEI, have both flashed red. They don't cause recessions, but they have been reliable warning lights in the past. But the problem is, they're both backward-looking metrics. They show what's been happening, not necessarily what's coming next. It's kind of like looking in a funhouse mirror. They kind of show you what's going on, but it's warped by time and policy decisions, especially with the Fed's rate hikes. But as investors, we don't just want to understand what's happening now, we want to anticipate what's coming next. And there are two forward-looking signals that Burry has been warning about since back in 2022. And these indicators may actually show us what's ahead for the economy before the next downturn hits. So the first is consumer debt, which sounds kind of abstract, but this is the area that is directly tied to Michael Burry's original short of the housing market before the 2008 collapse. And there are some interesting parallels between that time and today. So in the 2000s, housing mortgage lenders were giving loans to everyone with a pulse. If you wanted a 0% down loan to try to flip a house at a higher price, sure, the bank would give you the loan. And this led to a massive bubble in consumer debt. People had way more debt than they can handle, and it was all propped up on the assumption that housing prices would never go down. But we all know what happened next. The housing bubble burst, millions lost their life savings, and the crash was so big that the government bailed out the very banks making the loans to keep them from failing. But today, consumer debt is actually quite a bit higher than its peak in 2008. It has now ballooned to over $18 trillion. Now, today's debt is not exactly the same as the debt from 2008. Back then, the issue was mostly housing loans, subprime mortgages that defaulted when home prices dipped. But today, the pressure's more spread out. Credit cards, personal loans, auto loans, even buy now, pay later programs, it's all smaller debts that are stacked across millions of different households. But it's a pattern that Burry recognized 3 years ago when he was still active on Twitter, saying consumers are choosing violence rather than cutting back on spending in the face of inflation. And here we are, 3 years later, with debt levels still rising, which has led some investors to criticize Burry, saying he's like a broken clock that is always predicting a crash, and even a broken clock is right twice a day. But at least in this case, he may not have been wrong, he might have just been early. It wouldn't be the first time. Burry's first bet against the housing market took place in 2005, a full 3 years before the market eventually collapsed in 2008. But if Burry was just wrong in his warning about debt, we need to understand how rising debt could push the economy toward a recession. So let's zoom in on what this pressure actually looks like for everyday people. It's no secret that we have seen record inflation for years, and people have had to find ways to keep up with rising prices. And the easiest way? Take on debt. Let's just take an everyday example. Her name is Sue, and she has 2 kids, a decent car, and in 2019, life feels pretty manageable. Her family shops at Walmart for most things, and they go to a smaller grocery store for fruits and vegetables. Her kids are each in a sport, and they even go out to eat once or twice a month. Then 2020 comes along, and it gets tough, but they manage to get through it okay. But in 2021 and 2022, prices on food start to rise, and so does her rent. She wants to keep providing for her kids, so she starts putting little things on her credit card. A few $1,000s in debt turns into a little more. The next year, she takes out a personal loan to pay off the card, but prices are still rising, so she's still spending on it. Her debt payments are like a snowball that's starting to roll down a hill, picking up speed. Now it's 2024, and she's really feeling the pinch, and she can't keep taking out more debt, so she cuts back. No more fresh produce, restaurants are out, and even her kids now have to pick just one sport they can both play so she can afford the gear for both of them. And she's not the only one. By 2025, consumer spending falls across the board. Sue does splurge once on a laptop in March because she's worried that tariffs will push up prices, but she is tapped out on debt. And millions of families are hitting the same wall at the same time. A lot of folks, everyday people, are struggling to afford living their lives like they're used to. Spending is falling not because people are saving more, but because they can't afford to spend anymore. That is the real risk. When debt-fueled spending hits a ceiling, demand drops, and that is when recessions start to show up in the data. And that pressure on everyday consumers is starting to show up in how the smart money is reacting. Because while consumers are struggling under growing debt, some of the savviest institutional investors, who often see shifts before the headlines do, are quietly pulling back. Legendary investor Warren Buffett has built a record $350 billion cash file, and BlackRock's Larry Fink is predicting the U.S. may be very close to a recession if we're not already in the beginning stages of one. And then there's Michael Burry making a single targeted bet on a slowdown. So let's connect the dots here. The most trusted recession indicators like the yield curve and the LEI are flashing red. Debt is rising faster than incomes, and consumer spending is starting to break. And we're seeing some major investors seemingly move towards safety. So if Burry is betting on a recession, and even Buffett and Fink are signaling concern, what should we as regular investors actually do to prepare? Because the goal here isn't to copy a billionaire's trades, it's to be prepared and not surprised. So let's start with the good news. Not every signal in the market points right now to a crash. The job market actually looks pretty good, with the number of non-farm job openings trending downward and unemployment sitting at a fairly low 4.1% today. And since this is the third of those big 3 indicators of a recession, that is a promising sign. Plus, inflation seems to be finally cooling off after years of crazy price rises. Another arguably good sign, the Fed hasn't been cutting interest rates. Normally, that's one of the first moves they use to fight a recession, so the fact that they're holding steady suggests that they don't see an immediate threat. So there are a couple of mixed signals in the market right now. We could see a recession soon, like Burry seems to predict, or we might see one in 5 years, or we might not see one at all. But as investors, we should hope for the best, but prepare for the worst. So with so much uncertainty, here's how I'm personally preparing, without panicking or trying to predict the exact moment a recession might hit, and focusing on following a plan. So first off, I wouldn't try to time the market and copy Burry's short-term trades, like his put options on Chinese stocks. Because when it comes to shorting the market, you can correctly predict that a market will drop and still end up losing money if your timing is not perfectly right. I mean, even during his famous big short bet, Michael Burry almost lost everything when it took 3 years from the time he first started investigating the housing bubble in 2005 to when it finally collapsed collapsed in 2008, after his investors revolted and tried to pull their money out before the crash even happened. But if we do see a recession, there are a few moves that investors can make to help reduce their losses and protect their upside. First, trim high-growth names like highly valued tech stocks, as these tend to get hit the hardest in a downturn. Number two, you can lean into more recession-resilient sectors, defensive stocks like utilities, healthcare, and consumer staples. Now, a well-diversified portfolio should already have these in place, since an investing plan is only good if it works in good times and in bad times, but it is good to use warnings like Burry's as a chance to reevaluate and make sure our portfolios are properly balanced. Which leads us to number three, we should make sure to stay invested through the dips. Because even just trying to hold cash and only buy the dips still tends to underperform simply staying invested in the market long term. This study showed that if you had invested $10,000 into the S&P 500 back in 1995, so a mix of the 500 largest stocks in the US market, that would have grown to $224,000 by 2024. But just missing the 10 best days out of 30 years would have cut your returns by more than half. That is how costly market timing mistakes can be. So unless you're a hedge fund with millions in the bank, a long-term bet against the market is almost never worth it, since on average, the market does go up. Instead, consistently putting money into low-cost diversified index funds is the most reliable, data-backed way to build wealth in the long run. And even though things can feel scary when the market dips, every recession ends eventually, and the investors who stay calm and stick to the plan are the ones still standing when the dust clears, because the biggest gains tend to go to those who stay the course. Keep calm, stay invested, and if you want to keep up with the market, follow me on Instagram at RealFinTech, where I am posting daily updates. And YouTube is making its own prediction. It predicts that you'll really enjoy this video next. I'll see you over there.